Welcome, folks, to Money Club Mondays. I am filling in for Snaggy today, who is running around gallivanting throughout, I think it's Florida right now, but I'm not 100% sure. So doing on a business trip today, so I am filling as a host for him. And today we've got an interesting, we've got a really fun guest for us today, and that is Kevin Shortle. Kevin's going to teach us everything we wanted to know about notes and how to use those as an investment, because a lot of times we don't think that this might be a way to invest our money. So we're going to talk about that today. And yeah, it should be interesting. So if you guys do, if you have any questions, please put them in the question and answer, not in the chat. Sometimes I see them in the chat, sometimes I don't. In the question and answer, I am guaranteed to see them, and we will definitely go through some questions at the end of it. But so yeah, Kevin, how you doing today?
I am doing really well, thanks.
Awesome.
I spend a lot of time just on Zoom these days, and I really enjoy that, and just going through note transactions, and that's one of the things I'll talk about. You don't have to drive around, you don't have to walk through properties, and it's a lot nicer. We can sit here and just go through as much inventory as you want to.
Mm-hmm. It's a lot. It's not quite as passive as funds and various things, but it is, no toilets, tenants, and termites.
Mm-hmm.
And well, it's fun to do. Well, it's a lot of fun to do flips. That's how I got my haircut, because I did a flip. But well, it's fun to do flips, and it's something that's, if you really have a penchant for it and you really love to do it, it's great. There's a bunch of other ways to be able to make money with real estate, and that's it. And the notes is one of them. So yeah.
Yeah, because you can actually flip notes too.
Absolutely, yeah. Just like you're flipping, like with your wholesaling, you're flipping the contract too. So yeah, awesome. So how did you get into this? I've always been curious. How did you fall into notes?
Well, I'll tell you, I always had a keen interest in real estate, and I looked at real estate as soon as I graduated college. I became a commercial real estate appraiser, so I've always been in that real estate field, but I really wanted to become a real estate investor. And like a lot of people, I struggled. I tried to do it with no money, did some flipping, did the normal things. And I happened to meet a guy that he had just made, it was like 10,000, 12,000 bucks, something like that. And we're talking 30 plus years ago. And that was a heck of a lot of money back then, still a lot of money today. But I mean, it was like wow, how'd you make that? He goes, well, I flipped a note, and I'm going, well, wait a minute. And so he really kind of introduced it to me. And then I came up with the idea of building a national network of people that would find deals, run them through us, we'd get them funded, and everybody made a cut. And so we were able to do it very successfully, going from really a nobody in the industry to a top 5 company within the first 12 months. And it worked really well. We did it without using any of our own money, because starting off, we didn't have any money to work with. But, I always tell people the most important thing in this, like anything else, is the ability to identify a deal. Whether that's in the stock market or crypto or real estate or whatever it is, the ability to identify a deal is really most important, because what you'll find, especially in the real estate and the note side, the money's out there. So if you have a deal and you can bring that to the table, so to speak, well, then you don't have to have your own capital. Awesome. Always helps, if you have your own capital and really want to accelerate it and do bigger things, then absolutely that's an option. But so one of the things I like about this is the flexibility of this. You can put in as much time and effort as you wish to, and there's so many different facets within the umbrella of the note business. When I first got into this, notes was just a niche that very, very, very few people knew about. There was real estate and this note thing, that's kind of how it was. It was called the paper business and that sort of thing. And just kind of this weird non-touch, non-feel sort of thing. What do you mean paper? And, again, it was very niche play, and there's only a certain amount of things that you could do. And now it's really grown into something that even some of your well-known financial people in the industry. I always have a quote here by Robert Kiyosaki, and he talks about, notes being a part of people's portfolios. And you just didn't see that 30 years ago. Nobody knew what that was. But today, more and more people are recognizing it, that notes is really just the finance side of the business. So we buy the debt on the property, not the property itself. So we really act more like a bank.
Mm-hmm. And kind of, instead of having a bank lend out, individual people are able to lend out, which I guess is a little bit better. Now, is this something banks use, or is this just something that's unique to us? Or like a lot of times mortgages are sold as a commodity, so they bundle a whole bunch of mortgages together, sell it to another company. That's why if you have a mortgage on your house, why sometimes they will sell, you'll have another lender than you started with. Just kind of the background to it. But is that something that is that similar to what you do, or how does that differ?
Yeah. So and you're right. A lot of people don't realize when you go to a bank, to which everybody says get a mortgage. And by the way, you don't get a mortgage at a bank, you give a mortgage. What you're getting is money. You're getting a loan. And to get a loan, you have to promise to pay it back. Well, that promise has to be in writing, and that's a promissory note. But banks are also smart investors that say, okay, we have your written promise here that you're going to pay us back, but that's not quite good enough for us to give you $100,000 on a loan on your property. You have to pledge that property as collateral. So all the notes that we buy are really two things. There's the note and the security agreement, which will be a mortgage or deed of trust or sometimes a land contract. So we're buying both. So if we don't get paid, the property is our collateral, which we can go after either through a forced action like a foreclosure or voluntary release where they just sign the deed over in the case of something like a quitclaim deed. So our banks really have that same system with Fannie Mae, Ginnie Mae, and Freddie Mac. So when you go to a bank to get a loan, you sign those two documents and the lender immediately turns around and sells that paper to Fannie Mae and Freddie Mac. For what? In exchange for money so they can do another loan, charge points, and the whole cycle goes through that. So really, when you make your monthly payment to Wells Fargo or Bank of America, whoever you're making your payment to on the lender side, they're passing through, they're acting as a servicing company, and they're just passing through those payments to Fannie Mae, but they're retaining the taxes in insurance portion, which is held in escrow that they can get free float on. Because most people, they pay your taxes. I think you pay them up in New York twice a year. We pay them in Florida once a year. So they get that 12 months afloat on millions and millions of people's money. And that's a good way to do it. So banks do have their own secondary industry that buys the notes that are created. And that is what we do. But when bank loans go bad, it used to be that they would foreclose and go through the legal expense and the time frame with that. All of that completely changed with the Dodd-Frank Act. With the Dodd-Frank Act today, they've made it so financially penalizing on the banks to move quickly on these things that there was a complete shift. And instead of the focus being on foreclosures, and they still foreclose, there's always going to be foreclosures, but the percentage has dropped dramatically because banks bundle these bad loans up and then they sell them and they can get rid of them off their books within 30 to 60 days versus going through a foreclosure where it might be on there for 12 to 18 months. And when you have financial penalties that are imposed upon you as a lender, you have no choice but to bundle those up. So the rules of the industry have really changed. And that's one of those things that elevated the note business to such a higher level because our inventory went from, it's not just seller finance notes anymore on weird property. It's bank originated loans that have gone bad. And then we come in and buy those at a big discount, and then we fix them either by remodifying the loan, helping the person stay in their home, or if the people have left or just simply don't have the ability, it's cash for keys, move on. We won't foreclose on you if we don't have to, and move out and we get the property. So it's really such a strong play today that more and more people are starting to find out about it.
And I guess that's the reason why people are hearing more and more about this now, is just because this basically came out of the 2008 financial crisis, and that's kind of where Dodd-Frank came from and the shenanigans that went on there too, if I'm right. So yeah, awesome. So now, when you think about selling notes, there's a lot of different ways that you can kind of do creative real estate with minimum amounts of money involved in that sort of thing.
Sure.
So how does this actually work? How does it work? Like going out buying notes? Is there like
yeah? So there's as I said, there's so many different avenues under that framework of the note business. Part of me working with people is trying to establish, well, where are you going to start? Because you don't want to do everything all at once, especially when you're new, because you end up feeling like you're in the business, but you're spinning your wheels and you're not making money. So if you want to make money in it, you got to say, okay, I need to be exposed to all of this. I have to have a working knowledge base here, but I've really got to focus my efforts on getting that first deal, that second deal done, that sort of thing. So besides the different types of notes, performing or non-performing notes, you have to look at how much time and effort do you want to put in? So if you are working in performing notes that you're buying that have already been created, payments have already been made on them, that inventory is readily available, and you can be right at home on your computer looking at assets, making offers, and doing your research and everything else very quickly. So one of the funnels, if you will, of inventory for us are bank originated loans that the bigger companies bought at the auctions, and now they're selling off the smaller notes and pieces. That's one of the inventory sources we look at. The other source that's been growing very, very rapidly over the last 5 years, and I don't see it slowing down, is a lot of companies, and I'm sure some of the people on here have done this, or at least have talked about this. And I know that Stephen and Chris have talked about this, certainly, and some of the other speakers, where they're creating companies that go out and buy real estate. So they raise funds through a private placement or some kind of a play there, and then they buy real estate. And what they're finding is, if they focus on the affordable housing where the biggest demand is, the least expensive properties with the highest returns, the best option is to sell those with seller financing. Buy the property, sell it with seller financing. You'll sell it much quicker. So a lot of these companies go from, we have real property now, to converting it to paper in the form of selling it, and now they own the paper. Well, at some point in time, they have to sell that paper. Mm-hmm. And that's another source of inventory that we gravitate to. In fact, I'm working with a company right now that does that. They raise capital, they buy property, and they fix it up now and sell it. It takes them over 6 months just to start to sell the paper, and they do very little rehab on these properties. So what I'm doing is saying, I'll shorten that curve for you. I'll make an offer on that note before they even make their first payment. I'll make an offer. We'll put the thing in writing, but it's still going to be subject to 3 successful payments. So I'm locking up the deal, but I'm not closing on it for 3 months. They collect the payments for the next 3 months. And if the payments are made on time, boom, we have our price already negotiated and buying them that way. Maybe I shouldn't be sharing my techniques here. No, but it's one of the things I'm doing, but I've just shown there's so many different ways of doing this. And it all comes down to, where's the inventory coming from? And how do you tap into it? And of course, how do you research it to protect yourself? I always look at safety first. And, the rest simply becomes how you go through closing and that sort of thing. But the inventory levels are great today.
Okay. Yeah. And my 2 cents on it, or sorry, do you see this, like, we know that the real estate is incredibly intense here, even in Buffalo, here where we're at, it's still pretty intense. And do you think that the notes are going to change? Is this something that's, only if you're in a really hot market, is it going to do well, or does it do well when you're going down? Or is this just one of those all-weather things that you're going to make it work depending?
Yeah, one of the big differences, you said the key word there being your marketplace. In real property, there is a tendency, especially for smaller investors, to focus on one area, one part of town that the properties, the prices, a lot about it, and everything was location, location, location. Bigger investors in the real estate realm have a tendency to venture out a little bit further, and the ones with funds really don't care. They're buying them anywhere. In the note space, our market is nationwide. It's kind of a weird concept, but you're never going to go and see these properties. You'll have a BPO, you'll have a real estate agent out there taking pictures and that sort of thing, but you're not going out looking at the properties and that sort of thing. So it really just is a matter of, do the numbers work? And because it still is a people business, just like real estate, what's the story here? What's likely to happen if it's a performing note? So somebody was asking, do I focus just on non-performing or performing? No, I focus on where the opportunities are. And that includes both sides of that spectrum. However, that gets skewed based upon the individual's risk tolerance, right? And how much time and effort they want to put into the business. Today, I do have, and I've got, it's only like 4 slides. I'm going to show you guys a deal. We'll make time for it. It's a performing note that is available right now. And it's easy. It's an easy, what I call a turnkey note, meaning, gosh, it's got well over 30% equity, meaning they owe way less than 70% of what the house is worth. It's got, I think, they've been making mortgage payments for 15 years, something like that. And you get the payment history, and it's all just one of these with a bow on it. I mean, this is a really sweetheart deal, and they're not all like that. You can get more complex. The other spectrum, I'm working on some deals right now that we had to just turn down because the paperwork wasn't done correctly. There's some questions about really what the property is worth and that sort of thing. So they can, there's degrees of complexity that also affects the prices, and things as well. Yeah.
So just again, and just in case it was unclear about kind of what was going on here. So if I have a mortgage, it's going along well, it's kind of just, hanging out there. The banks are just trying to offload these to now free up the capital from the note to be able to then lend that money back out again. And so basically we reap the rewards for it. Does this mean that, if I have a $100,000 note, I have to put $100,000 down on it?
One more time?
So if I have to pay, do I have to pay the principal for the note? Meaning if I buy this from a bank and the bank wants to kind of offload it?
Oh, gotcha.
Right?
No. We buy, just like real estate, we buy at a discount, right? We always buy at a discount. And the discount is going to depend upon several factors. There's probably about 10 different things that I look at. And I always take the concept of there's always good qualities about a note and bad qualities about a note. And you start to weigh those out, and you're kind of the pendulum in the middle, and you have to say, is that within my risk tolerance? Is the return on that high enough for me? And I have another case study of that too, if you want to look at something like that I could show you also. I've got them pulled up on my screen here if you want to take a look at some of those. But that's what you do. So we never pay what we call par, which is what the unpaid balance is on the loan, which also means when the loans are paid off, you get what we call unrealized yield, because I might have paid $70,000 for a $100,000 loan on a $120,000 property, right? So when that thing pays off, they still owe me $100,000. I'm only in for 70. Not only am I making on a reworking loan maybe a 10% interest per year, but I'm also, when they pay that thing off, going to get a big payback then as well. And if things go horribly wrong, and property values start to go down and everything else, I've got 70,000 into a $120,000 home that now might be worth 100. Am I still okay? And that's the kind of thing that you look at and weigh that.
Because that's one of the things where, when I first heard about notes, and I hear this as well from people going, why would I just buy a loan that's already performing? Why wouldn't the bank keep this thing? And it doesn't make, or how would I buy, so a performing note when that's being paid on, why would the bank sell it to me?
Well, you're right. No, you're right. The bank won't sell it if it's performing. So the ones that trickle down from that funnel of the banks are all non-performing. Okay. That's where they have to sell them and get them off of their books. Okay. So we don't buy performing notes directly from banks. Now there may be a credit union where there's an off chance that they might have a loan that they need to move out of. But you're right. Why would they sell a performing asset? They're going to sell the stuff that's not working. But if I go back to my REO example, where the company raises funds, and many times when you raise funds like that, it's a closed-end fund where you might have 5 years of, everybody's got their money invested. At the end of 5 years, everybody's paid back and the fund goes away. Those companies had no choice at some point in time but to sell that good performing paper that they've kept, because they have to cash out the investors. I'm working on, in fact, this, if you want to go to it, I can show you a real simple one of a private portfolio. One of the things comes with longevity in any field is you build up relationships, right? And part of that is, I know plenty of people that I've trained 12, 15 years ago that built up big portfolios of notes. And then something changes in your life, and you say, you know what, we've made good money on these. Maybe I'll cash out on those and put it into another investment, or maybe I want to buy some newer inventory, now. So there's other reasons that people will sell these good performing notes. You want me to show you a simple one?
Yeah, let's do that. I know we're talking about funds, and that's the thing. So Chris and I and a couple of other folks are partners in a fund called cashflow. We do the same thing too, where we're selling the note. And it's, when we talk about notes, this is basically what we're doing. So basically, so there's going to come a point 3 or 4 years down the road where we're going to close the fund, just because that's the natural cycle of the fund, and we're going to have to liquidate some of that too. So that's the way we'll do it.
There you go, and you know where to find me.
Absolutely, we'll talk to you.
Yeah, and that's what what inevitably happens. So there's a variety of reasons why people do sell that, but you're right, it's not really the banks here. So I know there's some people that know me, there's some people that do not. I know they have on the various sites a lot of different videos that I've done, but for those who didn't, very briefly, I've been in this business a long time, over 30 years. And you start to get to my age, and you forget when you started, but you measure by other things. So I knew my wife and I just got married when I got started in notes, and we've been married 31 years now. So that's how I got to remember the time frame on that. So we've got my #1 bestseller there. That's still on Amazon, and I've been an educator in the business for a long time. I'm getting ready to start my podcast back up. I took a little hiatus from that, and this is a note that I got from Private Inventory. There are people that I've known that I trained in the business, and I used to do live 3-day trainings. So people would be there, the same people, over the entire weekend, watching me for 5-6 hours a day, going through all aspects of the note business, not just non-performing like some people do, or not just performing. You have to know it in its totality, and that's the way I taught it. And they used to come out to probably 10 trainings a year that I did. And I would always show assets, and some of them, say, hey, this one's available, this is a good one. I'd look into it. They ended up buying those. So a lot of these I've known for a long time. So these sellers I know and I trust, and they had about 6 other ones that they wanted to sell. My clients already purchased those, but I kind of tucked this one aside because I wanted to bring something to your show and to the Money Club here as an asset. So this is a live asset. You can buy this asset. And if you're interested, just shoot me an email and you can buy this note. I've gone through the whole thing, and I've just made it really simple for you to show you how this works. This is in Kalamazoo, Michigan. It's a smaller house, 845 square feet. It's a 2-bedroom, 1-bath, but the value's upwards now of $85,000. So you've got a nice working class neighborhood, which I'm telling you is the way to go. It's been the way to go for the last 15 years, and moving forward, it's the way to go. Affordable housing is a big problem in the United States today, and people need financing. So a lot of these notes are in the right price ranges with seller financing, and they can afford them, even if people's hours are cut back and those sorts of things, or unfortunately, if there's going to be some more layoffs again, as inflation goes up and people's cost of living, all these other things that people are dealing with is going to get probably worse. But because of the affordability on the payments, they're much better off staying in this house, making the monthly payment, than trying to rent a house or an apartment, because we all know what's happened to rent. So there's a lot of things that work in favor here as well. So this is the collateral. For those who are new to this concept, I'm not looking to buy this house. This house is what I will end up with if my investment goes bad. So at the end of the day, I always look at things and go, worst case scenario, if I have to foreclose because of non-payments here, I'm going to end up with this house, and then I'm going to own it for whatever I paid for the note. Am I okay with that? And if you're okay with that, you have effectively lowered your risk. So that's my collateral in an instance on this. What I'm going to do is buy the promissory note and the security agreement that is attached to this property. Okay, so just like a bank is how I look at that. Now, I didn't originate the loan. Somebody already did. In fact, the original loan was this. The original loan was $36,160 years ago. I've got the date coming up in a minute here, I believe. So this note's been around for 10, 15 years. And in the meantime, the property or the collateral value has gone up, but they're also doing what? Establishing equity. Equity is established really three ways. Your down payment is buying equity. When the property value goes up and you're paying the debt down, those are the other two ways to create equity. The more equity somebody has, the more motivated they are to stay and pay, right? Or once again, if things go bad, sell that house. I hope you get $85,000 for it and you're going to pay me off on my loan. I'll never have to foreclose on this property. It would never happen. They would be foolish to let this go into a foreclosure when it's worth $85,000. Sell it for 85, pay me the 30 something that you owe. But this is the original loan. So it started at $36,160. You can see that this was a seller finance note because it's not a bank rate. It was written at 9.9%. And I know a lot of people sometimes go, why in the world would somebody buy a house and pay 9.9%? Well, right now, they're doing a lot of comparisons between the 1970s and right now with inflation. Go back and look at the bank mortgage rates in 1970s, 18%. I mean, it's crazy. That's number one. Number two is if these folks could have received a bank loan, well, go get a bank loan. They couldn't. But you know what they look at? It's the monthly payments. I mean, I don't know that I did this, but somebody in the background could look up what's the typical rent for a 2-bedroom, 1-bath in Kalamazoo, Michigan. It's going to be more than $315 a month. I guarantee you. It's probably closer to $800, you know, would be my guess. So their payments low. That's what they're looking at. That's why 9.9% doesn't bother them, because a lot of people think, look, we can afford a house though. We can afford these payments, and down the road we'll do what? We'll refinance or, you know, whatever down the road. That was the original loan. Now, I'm not buying the original loan because time has passed. What they're asking for on this note is $34,249. That would be your purchase price here. You would be buying 285 payments of $315 per month, giving you a 10% return. So if I take the quick math, I made the slides a little too brief there for you. Let me show you what's going on here. So the original loan, $36,160 at 9.9% interest, and there was 360 payments, and that should equal 314.66. I rounded it to 315. So that's the original loan. So now we have 285 payments remaining on this. So the present value of the loan is just slightly above this. So this is a scenario, which is kind of interesting, is you're paying fairly close, very close to the unpaid balance on this one. So we're not seeing that big of a discount. Sometimes this happens because this is what we would call a very well-seasoned note. The people have, and you get to see the payment history and everything else on this one. They've made how many payments here? Where did my calculator go? 360, 60 minus 285, 75 payments. Okay. So they've been there over 5 years, right? 6.25 years that they've been making payments on in this house. And they're not going anywhere. They're establishing equity. So you are paying a little higher as your investment relates to the unpaid balance, but your risk is so low because if you invested $34,000 into this note and the property is worth 34,000 and the property is worth 85,000, you're in it for 40% of the value. So again, worst case scenario is if for some strange reason, after, you know, over 6 years of making payments, something happens and they can't afford to make the payments, you've got collateral that's worth probably more than 85,000. Your money is very, very safe on something like that. And many times these prices are a little negotiable too, but when you have a premium note like this, you could expect to pay a little bit higher what we call the investment to UPB ratio. In fact, one of the bigger buyers who's been around for about 40 years it's a bank-owned company, First National Acceptance. They've got $4 billion worth of notes. They buy and hold notes, and they will pay up to 98, 99% of UPB. That's this unpaid balance number. They'll pay upwards of that if the property is 30% equity, check. And if there's a strong payment history involved, check. So it's the same scenario with this note. And that's just a very simple note where what can go wrong? I mean, if it goes wrong, you get the property. If they continue to pay, great. You're going to make 10% per year. If it does go bad, they'd probably sell the house and pay you off anyhow. So very, very safe. That's an example of a quick performing note. And it is available, by the way, everybody. Go ahead, Andrew. Sorry.
No, that's fine. So I was going to say, if you, for more information, if you want to take a look, and if you want to either get in on this deal, or if you want to talk a little bit more with Kevin, I have put a link in the chat.
Thanks.
Then you can kind of take you can book a call with him, and or you can, let me just type this here. This is a different keyboard that I'm used to. It takes me a lot longer. I'm going to post this in the...
Yeah, if they want to book a call or something. Yeah.
Yeah. Absolutely.
And I know we might be low on time here, but I'll take any questions that you have. I've got another little case study here. It's a little more complex, but
yeah, we have plenty of time.
The business doesn't have to be that difficult. You know, what I just showed you was one of those examples of a turnkey note. In fact, one of the people in the Money Club, he goes back a little ways now, he saw a deal that I posted on Slack. And same thing, it was about a 10-minute video, 4 slides. And he got started with me and bought that first note. He's already purchased 3 other ones now. And his focus has really largely been on these turnkey performing notes because it's simple, it's quick to do. There's not a whole lot of research. It's more verification of information. You can always make these offers subject to a title report, subject to a BPO, that sort of thing. So you're not completely blind. So I don't want anybody to have that impression of, oh, I'm just putting all the faith in it. No, you'll have somebody out there taking pictures, looking at the property, giving you a BPO and looking at all the histories and the payments and everything else. And that's quite different than some of the other deals that we look at that are non-performing. But I'll tell you what, for those who are scared about the economy and where everything is, I mean, we're basically scared of all this stuff that's happening here, the stagflation, recession, and everything else. You got to take a look at notes because there's so many different things that we fit into that will really not be as affected. All of us are going to be affected by inflation, right? That's everybody, because that's the cost of our dollars and such. But a lot of these other things, we won't be infected. In fact, one of the program, I've got 4 of these deals under works right now. The government created this homeowner assistance fund where they have provided just under $10 billion amongst all the states. Everybody got a different amount of money. And this plan was purposely put into place to help people stay in their homes, which again, if we start to see people's cost of living go up and they can't afford to make bills, they start to prioritize and eventually get to that point of, I can't afford to make my mortgage payment anymore. This program has already been funded in every state of the United States, and 90% of the states now have implemented their plan. I've got 4 or 5 clients working on deals right now, and this might attract some people who want to buy the scratch and dent type of loans versus a turnkey loan, like I just said, like I just showed you rather. Take a look at this one. I just rounded the numbers on this one to reflect a deal that a current client is already working on. Property's worth 60 grand. They owe 200 payments left. 33,000 is their unpaid balance. But in this state, and this happens a lot in Indiana, by the way, in this state, they've let the property taxes accumulate all the way up to $25,000 in unpaid taxes. We have to know about that because property taxes in every state in the United States jumps ahead. They are the most senior lien that there is. And that puts your investment, even if you're in first position, it puts you in jeopardy. You could be wiped out in a scenario like this one. So the non-performing note, this one, because it's not performing and it has another lien and that lien is senior to you, the price on this one is $20,000. He's actually getting for just under $20,000. I rounded it up a little bit. Property's worth 60. So you're very safe there. You're coming in at $20,000. So if you do have to foreclose, you're going to be just fine getting a $60,000 house for 20 grand. If you can get it working again, great. Okay. This is not an actual picture of that house, by the way, it's just a stock photo. The other one was an exact picture. This one's a stock photo. The UPB is 33 grand on this one. So in steps this new mortgage financial assistance program. Okay. So this property happens to be located in Alabama. Alabama will pay up to $50,000 per family to help them stay in their home. Okay. So the homeowner applies for financial assistance. Now, first of all, a homeowner knows nothing about this program. Why? Because it's a government program and everybody who needs it knows nothing about it because they don't advertise it. And this happens over and over again. Happened the same time they had a similar thing called hardest hit funds back in the day. So it takes about 90 days to get approved. So this 25,000 was not just property taxes. My bad on that one. It included the unpaid monthly payments. So the borrowers, in other words, haven't been making the payments on this in a number of months, right? Probably a couple of years now, plus they owe property taxes. Sorry about that. The property taxes in this case were $2,000. That's what was owed. So this fund is going to pay directly to the state, or pardon me, directly to the county, from the state to the county, the $2,000 in property taxes. So that'll be gone. Okay. Now, did you as a note holder benefit from that? Well, yes and no. Those taxes would have had to been paid by somebody, and it might have been you to protect your own money. So in a way it did, but they're the direct beneficiary from this. In addition to that, they're also going to pay you, the note investor, the $25,000 in those unpaid payments that they have, okay, that they've accumulated there. It doesn't matter what you paid for the note. Okay, it's what do they owe. So if they owe 25,000 and they want to prevent a foreclosure, they've got to come up with a 25 grand. They don't have the 25 grand. The state gives that to them. So that 25,000 is paid directly to you, the note holder. We only paid 20,000 for the note. 90 days later, you're getting $25,000 back, just if you're paying attention there. Plus, the state's going to agree they still need some help. So we're going to pay the next 12 payments as well. So here's 25 grand. And then on the first of the month, every month, we'll automatically send money into your account for their next 12 payments. After those 12 payments, you still own all the remaining payments. So they're still going to owe about 200 payments after the other ones are paid. Okay. The UPB, was 30. They caught up on all the payments, caught up on all of the taxes. In this case, you own that note, you've already made a profit on it. I mean, you can't calculate what they have because all the taxes and all the unpaid payments have been paid by the state. And now you're going to get those last 200 payments for free. You already got all your money back. Plus.
That is brilliant. And you help the homeowner keep staying in their home. I mean, that's the other part of it.
And that's the goal.
I like to do things.
That's the goal of it. So you're after the 200, right? You get 188 payments left. Subtract out the 12 that the county paid. It's an incredible program, and this program they had a similar one back in the crash of 2008, but they funded a lot less money in only 18 states. This time around, every state got money, and more money was put towards it, and not many people know about it. So, imagine buying these notes. The people want to stay. You're looking for things like, are they taking care of the house? All that sort of stuff. And you get them to apply. And I've just over the weekend, it's great to get, my clients can text me and email me over the weekend. I got a couple of updates from people. One guy in particular is working on a deal in Pennsylvania. And the people got all their paperwork filled out. They've got it submitted now. And he's pretty excited about it because this program works and they have to spend this money. If whatever the state doesn't spend has to go back to the Treasury Department. Yeah. And I don't know a single state that's going to want to do that.
No, they're going to try to spend as much as they can. That's generally how it works. Awesome.
Yeah.
Huh. No.
So that's, again, when you talk in terms of what's going on in the world today and in the US, when you look at affordable housing and the payments that people are making and the assistance that's there through the federal government that's already been funded, it's a real strong argument for telling people you got to get involved in this.
Now, with these government programs that are here, like you said, there was one through about the 2008 crisis. There's currently one now that's a lot bigger. Is this something you see regularly happen, or is there going to come a point when it's like, well, we may not have anything to help out a distressed, I would say, a distressed property or a non-performing note?
The first time that it's ever happened was in 2008. So it was right in between Bush and Obama, and we had 10 million people that were facing foreclosure at that point. Because it was a different time, right? We had property values that went like this, but we had easy loans and people were buying $200,000 on a $200,000 house that they couldn't afford with very little to no documentation. And boom, now the property values get cut down in half, but they still owe 200 grand. So we had a lot of upside down properties. And that's where, I don't care what administration's in power, none of them want to foreclose on 10 million people, So they came up with this program and they funded it initially at 7.2 billion. And they gave an extension after the program expired because the money hadn't all been allocated. And the states did a very poor job of getting the money out there. And everything I've seen on this program that I've been investigating and looking into it, which I've been doing for a year, I knew they would come up with something here. And they took all of the best things that worked before in the program, got rid of all the bad stuff. And that's what I think you're seeing on this new program here. So this is only the second time ever that it was done. And this one really was largely done because of COVID and people not working or hours cut and that sort of thing. And again, goal is the same though. How do we keep people in their homes? Well, catch them up on their payments or make their payments for them or some combination thereof. And that's what this program does.
Mm-hmm. Okay. But it's something that, what I'm thinking is if somebody was to get involved in notes and they want to do this longer term, so there's only, 10 billion, it sounds like only $10 billion, but that's really doesn't go around a whole lot when you've got, 300 and something million people in the US. Is there other ways beyond using government funds to be able to help a distressed homeowner and kind of get them back on track again?
Sure. And I could even still, use this same example here. You never buy one of these notes just assuming that these people are going to apply and get approved and you're going to get that money, right? We can't do it that way. So you go into these things with a plan A, B, C, D, right? So your plan A for sure would be to have them apply for the government funds. And you would think that would be, that would be easy. No, a lot of people, they don't want to talk to the lender, and you're just another lender and they don't answer letters and they look at programs and go, it's too good to be true, sort of thing. So part of it is letting them know that this is a real program. Here's a number that you can call. Here's the website, that sort of thing. And we've had door knockers go out and hand deliver stuff, all that. So that would be my plan on this property. Number one. If that doesn't work, can I still do a loan modification on this without the government money? Sure, because I still have, 200 payments that I'm entitled to here. They still have a between the taxes and everything else, they still have, that number's a little off. They still owe about $25,000, but, I could work out, look, you pay the property taxes, get that caught up, number one. I'll take the rest and do a forbearance agreement. Okay. And then we'll do a trial loan mod where you start making payments again, or maybe I have to temporarily lower the payments so they can afford it for 6 months and then modify it again. So a mod without the government funds would be my second option here. The third option would be if they're just continuing to refuse to acknowledge letters, call servicing companies back, and attempt to make any payments, we have no choice but to file a legal action, which may be as simple as just a demand letter, by the way. It doesn't have to be a formal foreclosure. I had another email from somebody this weekend. They followed my advice on that. I said, don't have your attorney do a full foreclosure and pay for or start the foreclosure because you're going to pay more for that. Just have them start with a demand letter on their law firm, legal letterhead. And it's amazing how quick sometimes you get a response. And sure enough, they did. So that would be my next phase of this. Nobody really goes into this wanting to foreclose when people are living in there. If it's a vacant home, different story. But the worst would be I'd have to foreclose. But either way, I'm making money on this deal, right? If it's truly worth the 60,000 and I'm only in it for 20 grand, if this works out, I've hit a grand slam. If I end up getting the loan modified again and making good payments on a $30,000 balance that I only paid $20,000 to, great. I've hit a triple or a home run. If I end up having to get a quick claim deed from them to get the house, okay, I'm back to home run top. So it's hard for you to lose on something like this, but you go into it with multiple exits.
Well, it's what it's like we do with real estate in general.
Sure.
You start with wholesaling to try to get the note, try to get the contract sold as quickly as possible. If you can't sell the note, then you go on to wholesale it, and if you don't do that, you go on to buy and flip. There's a bunch of ways there's more than one way to actually do this. So
exactly, yeah, cool. Yeah. So there's a lot of things, just like in real estate. You'll make money if you buy right, right? If you buy right, you'll make money. It's just a matter of when and how much. Yeah,
exactly. And sometimes having to, in business in general, sometimes you have to shift modes and go, well, that didn't work. Let's do this one now.
Sure.
Yeah. So we do have one question. Do you generally buy senior or junior notes?
I focus predominantly on, although I teach and consult on both, the senior loans being in first position, you're going to find much more attractive today. Juniors, the price has gone up so much. Juniors for a period of time were a great deal because you could buy them for 10, 20 cents on the dollar. But today, you're not getting that same price, and unfortunately, a lot of times with the second position loans, it's almost a bluff game. You have to threaten to foreclose because you can foreclose from second position, subject to the first, and that's where the subject to the first portion means a lot of people will threaten to foreclose from second, and then find out, oh, but I got to pay off the first to save my money. I'm not going to do that, and then you're just kind of waiting. You're just kind of a lien on their property, just waiting one day, hope that they sell it. So I think there's a lot more opportunities right now in the first than there are seconds.
Excellent. So let's see. So we've got.
Can't believe that's all the questions.
That was it. I know. That was the surprise.
Usually the government program is like,
I was expecting there to be a lot more, and I'm sitting here going, what are we going to do now?
Made it too clear for them. Yeah,
exactly right. But it's fascinating. Everyone thinks that, actually, I have one question for you when I get done with this, but everyone always thinks that with real estate that it's either, I only have to buy the houses, but I don't want to buy a house in Louisiana because I've never been there. I don't know what this is. I don't, there's so many different ways to do real estate and so many different entry points to it. And just, it always amazes me that no matter who you are, what side of the political spectrum you're on, whatever type of person you are, doesn't matter where you live, whatever it is, whatever demographic, real estate is the one common denominator and is the one way to really build wealth. And there's so many different ways to do it. It's just, it always fascinates me when whenever I hear new things and new ways of doing it.
And I'll tell you, notes really completes a real estate investor. I think a real estate investor without at least knowledge of the note business and how it works is not really complete. And the reason for that is that the note side is just the financial side of the real estate. So if you've ever borrowed money, whether it's private money, hard money, bank money to buy real estate, you've been involved in the note business. You've just been on the paying side. There's a whole other side you can get into it, which is on the receiving side of that as well. So I work with a lot of real estate investors and teaching them the note side to make them more complete in what they're doing, but also, showing them the right way to create notes and the wrong way to create notes and why you do certain things and how you set them up. It's a little bit different today if you want to create a good quality note. So for those who I saw a question, do you partner with people in deals and that sort of thing? I bring good deals like that turnkey note will sell. I've got no question about that. I thought I'd bring it to you guys first before I showed it to my clients. To show my clients the other 6, which they gobbled up. But the partnering side of that, I'm working on a program right now where I'll be doing some of that. I do want to limit that because I don't want a conflict of interest. I work one-on-one with people as private clients. So it's not just one of these, here's a book and tape or here's videos online. I actually get on Zoom calls like this and go through deals where we go through paperwork. This one, guy just bought this one, and again, I just took snippets of this, but this one had some drawbacks, had some good things, and these are all documents that we had to look through. You can see a signature was missing here, and found out what other properties people owe. So there's a little bit more to it, but I spend time with people one-on-one going through all that with them, and that's a big difference for that. So if anybody's interested in that and work with me and finding out more about what I do to help you, you can shoot me an email or book a call as well.
Johnny Barr has a really good question. And how do you service the notes that you've purchased?
You want to use third-party services. So there's about 3 or 4 that most everybody uses in this industry, depending upon what you're looking at. One of them out of California has 14 billion under management. And then you've got a smaller one that's a little more personalized out of Spokane that has substantially less than that, and fewer employees and that sort of thing. So we always have third-party servicing companies. And what they do is they collect the money. If there's escrow, they hold the escrow. If the people are late, they send out late notifications. They make outbound phone calls. And that costs you anywhere from $15 to $30 a month. And they take it right out of the monthly payment. A lot of people who are creating notes the right way add that fee in and pass that along to the borrower, by the way. But if you're buying a note that they've already agreed upon the terms, well, they take the $30 out of your $530 a month payment, and it's done that way. When notes are self-service, like this one, which we won't have time to go into here, but I showed this one to my clients the other night. This was a case study of a guy who owned this property, and he self-serviced it. And he made some mistakes, which is he can't show us a printout payment history like you would get from a servicing company. He showed us some checks that the people had written to him. He's holding escrow, but the taxes and insurance haven't been paid. The taxes haven't been paid in 2 years. The insurance has. That's hurting the value of the note. But if we're buying that note, which I have a client who's buying this note, that's a discount, right? So it works out both ways. So when you have servicing companies doing all that, they're licensed, they're track all that stuff, makes your accounting easy and everything else. So that's how we do it.
I used to work for one of these servicing companies as well, and they have the processes down. It is okay. Let's take the mortgage. Let's just do this. It is so much easier than trying to do it yourself.
Yeah, and all of them
is worth the $15 a month.
And all of them have a portal now that you just log in. You see where everything is. If a late payment hasn't been paid. Some of them even show you the outbound calls that they've made, what the person said. I mean, so it's well worth it. You don't want to self-service notes unless, there's a rare occasion where I've recommended that to somebody on a really small note, but it's just one or two at a time. But yeah, you start building up a portfolio, you'll get away from that real quick.
True story. So one other quick question we have, what's the least amount needed to get started? I was going to kind of go with my question of, you said you started this with no money. Mm-hmm. What is there a minimum amount you'd recommend? I know sometimes with real estate, we say you can do it with zero money, but it doesn't necessarily mean it's going to be done with zero money. There's going to be a lot of effort involved in it, and sometimes it just doesn't pay off.
I think if you go to my website, kevinshortle.com or realestatewithout.renters.com. I think they take you to the same place. I do have a free video there that says how to buy notes for under $500, and there's 3 techniques in there. What it boils down to answer your question quickly, is that you don't have to have the money to close a deal, just like in real estate. And I don't know if we were talking, I think this is when Andrew and I were just chatting before we started here. A lot of people in real estate started wholesaling real estate, right? You find the deal, you bring it to an investor, they close on it, you make some money. You can do the same exact thing with a note. You find the note, you bring it to a note buying company. They tell you, here's what we want to pay. We'll pay you $80,000 for that note. And you go back to your client and you say, we'll pay you $75,000. They're going to pay $80,000. They're going to get $75,000. You're going to get $5,000. And that's exactly how I started in this business. And there are companies, the good thing is, there are companies that are there just waiting for your phone call that buy $9 to $10 million worth of notes per month. And if you find a good note that fits in their criteria, obviously it's smart to find out what their criteria is first, find the notes, and then bring them to them. I think they're top, I know for sure they're top two brokers, if you will, last year made six figures, just bringing notes to them, not putting any of their own money in it. So that's really another way to do it. Second way real quick is a little bit more complicated, where you find a note and you put in $500 and you own a part of that note and the investor puts in the rest of the money, but the numbers work out pretty amazing.
Interesting. Yeah. So if you guys,
I didn't get, there's so many things I can go into, like partials are fantastic, but you run out of time. Yeah.
And frankly, I could sit here and listen to you about this stuff all day. I mean, I sort of eat, sleep, and breathe the creative finance side of things, and this is just so fascinating. Where you're basically doing the same thing the banks are doing and buying and selling notes, but you can do it at whatever level you can. You're not going to go buying $10 million in notes. It might be a smaller amount, but it's just interesting, and I love that sort of thing. Mm-hmm. So if you want to hear more from Kevin, then be here in Buffalo. We're going to do our Buffalo event in the end of July. Let me share my screen here. We'll show you a little bit more about it. There we are. So you'll be here at our event in July 30th and 31st here in Buffalo. I can tell you it will not snow. I can guarantee that in July. We never quite know in May, but I was telling Kevin when we first started off, it did snow here a couple of weeks ago. So if you ever want to learn more about this and a bunch of other things, we have a jam-packed list of people. Kevin will be there. I'll be there. Spencer will be there, our crypto person. There's a few different levels you can get involved in. You can either get involved with the virtual only package. So that's just a virtual package. So if you can't actually make it here to Buffalo, that's the best way to do it. The general admission package as well. We have limited that to 80 different spots. It's not close to 80 at this point. We've definitely sold some of those. That's actually coming here to Buffalo and being able to be part of we're here at our facility. We actually rented a facility just down, not too far from us, to be able to do this. And then the VIP is even better, where we're going to take you to a baseball game. So we actually have a decent baseball team here. It's definitely not like the highest end, but not bad. The field itself is only about 30 years old, and it's a beautiful field. The specific box that we have rented out for that night is a 1950s themed box, and so it's really kind of a cool experience that we have. So there's only a few different. So we're not quite at the. Let's see. Yep. So for the virtual admission, just the virtual is $197. The general admission, that means coming here to Buffalo to meet us all and get your networking in, is $297, and the VIP is $997, and that includes the baseball game and a whole bunch of other higher end, great networking with other people. If you can, I will put the link here in the box or in the chat for you if you're interested in coming to the event. It's always a great way to learn about new people or kind of meet some new people at masterminds like this. I don't know about you, Kevin. I've been to a bunch of masterminds, and I've met some of the greatest people that I know that have really helped me to move forward. So not only the information that I learn, but just the people that I meet through these things are truly worth the money.
I concur. And I'll be at the VIP and plan on sitting down and meeting as many people as possible. And let me just say, if you haven't been to a live event, because I know with COVID and all that, I used to do live events more than I really ever want to do. Again, I was going out 2 times a month, teaching 3-day classes, doing a lot of travel. I don't miss that part of it, but I'll tell you, I've done 2 live events this year, and it's so much different than the virtual. If you can make it live, I'm telling you, it's worth it to go there live. There's a different feel. You get a lot more, time with other people, which is an important part of this whole thing. I really enjoyed it. That part I miss is the live event. So I'm really looking forward to Buffalo and being there and really meeting people face to face. If you only can do it virtual, I get it. And if you're, for whatever reasons, no problem. But I'm just telling you, if you're on the fence, man, I really enjoyed the live events I did this year, Jessica. It's just a different vibe. Yeah,
I totally agree too. I've been a virtual trainer for 15 years, and so I've done it a couple of years, and I'll tell you, there's nothing like live though. We can kind of get virtual going, but virtual networking is nowhere near the same, and I think a lot of us learned that. So absolutely, coming out to Buffalo. Buffalo is gorgeous that time of year, by the way, too. It's warm. It's not too warm, not too much humidity. It's just a beautiful place to be in that time of year. So if you'd like, folks, in the chat, the link is there. Please feel free to click the link, moneyschoolrei.com/July-event, and sign up for it. Other than that, folks, thanks for coming to see us today and to learn more about notes. Kevin, thank you so much. I always love listening to you talk about these things. No matter how many times it is, I learn something, and it's just fascinating what you do.
Yeah.
So
Awesome.
Thank you so much. I really
Thanks, Andrew.
appreciate that. And you guys have a great rest of the day today.
Thanks, everybody.